From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, June 7th. Here are the top market stories that we're following for you at this hour. Target turmoil. The stock falls 3%. The company cutting its profit outlook for the second time in 3 weeks on bloated inventories. It's not the economy, stupid, just stocks. Target's margin meltdown drags on equities while economic data and the consumer hold up. A Fed soft landing, though, can still spell pain for investors. And stagflation nations. The World Bank says the global economy is in danger from high inflation and slow growth for years to come. I'm Alix Steele in New York with my co-host in London, Guy Johnson. Welcome, everyone, to Bloomberg Markets. My takeaway so far is if you're going to want to shop on sale, you're going to need to go to all the major retailers. That's the takeaway. We'll see how long that actually lasts.
Yeah, it depends what you're going to want to buy, though, isn't it? Basically, the problem here is the consumer taste is moving really quickly. As I heard somebody put it a little bit earlier on, not interested in swimsuits, but we are interested in suitcases. It's that kind of trade. It's that kind of nuance here. This is basically a misexecution issue at Target. The question is there a macro signal in here? And that, I think, is what we're all trying to figure out right now, Alix. Or is it simply that we've got a little bit of a problem with Target and maybe some of the other retailers because consumer tastes are changing really quickly. And once we get back to school, once things bounce back, we'll be back to business as normal. We will wait and see. But let's kick it around because I think it's relevant to where we are with the U.S. economy right now. So does a margin meltdown mean a stock crash? That is basically what we're asking here. Let's bring into the conversation Mike McKee, Bloomberg's international economics and policy correspondent. We've also got Poonam Goyal, senior analyst for U.S. retail at Bloomberg Intelligence. Poonam, let me ask you this question first of all. Is there a macro signal in Target's announcement today, or is this a one-quarter, possibly two-quarter problem that they're still working their way through there?
It seems more like a Target problem, not a macro problem. Keep in mind that Target just came 3 weeks ago, along with other retailers that had all cited that there is an inventory glut. What's changed in the last 3 weeks is likely Target-specific internal execution and them having to clear out more than they expected.
When, though, Mike, might we know if it's more than just a Target-specific issue? Because we're still buying stuff. We're just changing what we're buying. And I'm wondering how long that part of it, that we're still buying stuff, stays for.
Yeah, it's been interesting. We expected a much bigger switch to services spending than goods, but that hasn't really happened yet. We're still buying a lot of goods, which would be good news for Target when you consider the inventory situation. Friday, we'll get an interesting number, and that is the CPI for apparel. We've seen inventories rise significantly, and you can see in the last month, apparel prices started to turn down a little bit. If that's going to happen, that would be good news for consumers. But again, as Poonam would say, it may be just a Target thing, and it depends on what people want to buy within that category, as long as they're buying goods.
Absolutely. So what does this tell us about the consumer? Mike, where are we with the consumer? Some people tell me the consumer's in great shape, that we've still got a savings glut that we're going to spend. Look at what is happening with the airline story. People want to go out, they want to travel. Then I hear other people saying, well, this savings glut is being run down very quickly. The consumer's not worried about a recession, so it's comfortable doing that. Which is the right answer here? Where is the consumer? What's the right signal to take?
Well, somewhere in between seems to be the answer, Guy, because we are seeing savings run down. Last month, they fell to 4.4% was the savings rate. It had been as high as the 8s. And so there's a little bit less money in the accounts. But right now, so many people have jobs that they feel like they can keep spending. One interesting thing to watch for going forward is in the PPI, the Producer Price Index. We saw trade services, which is basically retailers. We saw prices go down in the last month, and that means margin compression. And so let's see if that continues when we get the PPI report next week.
Well, I think that raises the question, Poonam, is that how much more pain are these retailers going to feel? I mean, you see like Walmart in particular also down in sympathy with Target. Like, what changed in 3 weeks that they had to announce again?
Yeah, this is clearly an execution issue on their part because not much has changed in the last 3 weeks. We've known that there's been an inventory issue since February of this year is when e-commerce and retail companies started reporting. So it's really execution on their part. And, where I think there's a load of inventory that they need to clear is in the home and electronics space, categories that had flourished through the pandemic. So probably they got ahead of themselves and ordered more than they could actually sell through this year.
Poona, what happened to the second half? The company's guiding us back up to around 6% in terms of the margin. Looks like we're going to bottom out around 2. Is 2 the bottom, and how hard is it going to be to get back to 6?
2 should be the bottom. I mean, coming around at it the second time in 3 weeks, you would expect 2 to be the bottom. Getting back to 6%, listen, if once they get the inventory out, if they clear it by the end of the second quarter, then getting back to 6 is reasonable. Keep in mind, they had 8% profit margins at the peak.
Right, and it's just still part of the unwinding of the stay-at-home trade versus reopening. That still feels like what we're in the middle of. Mike, then I wonder, and this gets to a piece that John Authors wrote in Bloomberg Opinion this morning, is that can you have something like a hard landing for the equity market and a soft landing for the economy? And it feels like Target is a really good example of something like that.
Well, we can define a hard landing for the economy as a recession. I'm not sure how you describe a hard landing for the stock market because it depends on your tolerance for losses. You get to a bear market down 20%, that seems pretty bad. It doesn't look like we're going to have any kind of equity crash, but we are going to see companies struggle for a while to work through the remaining problems that come out of the pandemic and the things that are getting thrown towards us because of the ongoing war and COVID. I mean, we don't know exactly what's going to happen with inventories going forward because China, again, shut down so much of their exports. So we could see some additional problems along these lines. And it's going to be hard to tell when we're out of this. And also the interesting question that I can't answer, Poona made the point that people are switching back from buying a lot of electronics and home goods because the work from home thing has sort of been fulfilled. But what is fashion going to be like? What are people going to want to wear? Are we going to decide that we are all more casual because we work from home part of the time? And retailers are going to have to adjust to that as well.
Well, this is the point, isn't it, Poona? We are in a very uncertain environment. And we talk about the execution risk that is showing up in Target. I'm assuming other management teams are facing similar problems here. How easy is it to predict consumer behavior right now? We are seeing a huge splurge of a summer. Everybody wants to travel. There's backups in weddings. There's all kinds of things that we all want to go and do. The cost of living squeeze in some ways hasn't really bitten. I know we've got gas prices up around $5 a barrel, but there is potentially more still to come. How easy is it to predict the consumer going forward from here? How easy is it to predict for these companies where they should be investing in inventory?
Yeah, it's never easy to predict where the consumer is going for retailers. Keep in mind, they have to make these predictions 3 to 6 months in advance most of the time. So most of what you're looking to sell in the summer has already been placed back last year, and it's coming to stores now. In terms of, where the consumer is shopping, what they're buying, they're going out more. They are going out, and we're seeing that with fashion. Fashion demand has picked up. If the inventory isn't available, stores like Rent the Runway are doing well because they have the opportunity to deliver fashion in a timely manner, and it's at a value, right? If consumers are feeling that they want to spend a little less because they have 10 weddings all of a sudden to go to versus maybe 1 or 2 historically, where's that money coming from? They can't buy 10 dresses. So are they renting? Are they buying used? They're shifting. They're shifting where and how they spend too.
Guy, to your point, though, Union Pacific also today said that they weren't going to reach their profit goals for this year because of higher costs for fuel and network inefficiency. And Union Pacific is thought of one of those companies that are really good at managing those things, and they're also still getting hit.
Yeah, it just strikes it's a really tough environment, particularly as Poona says, you've got to, if you're a retailer, order so far in advance. Now, some of those supply chains are coming in a little bit, but nevertheless, it is a huge challenge. This summer is an anomaly. This summer is not normal for the retailers. It's not normal for the airlines. It's really hard, I think, to predict where we're going to be in 6 months' time. If fuel prices in October, November, December are $4, $5, $6 a barrel, it is getting to the point in the UK where it is £100 to fill up an average car. Now, that's a really big deal. And as we work our way through the rest of this summer and work our way through this kind of pent-up exuberance, I think come the later part of this year, last part of this year, really difficult to predict how people are going to behave.
Yeah, that's some serious money. Hey, Mike, last question to you here. Final word. So, I mean, Guy was painting a pretty pessimistic picture of how much you have to pay for a gallon of gasoline, and I'm wondering, when are we actually going to understand what the consumer impact is?
Well, we're already starting to see a little bit of demand destruction for gasoline. And that's an interesting question, is how much more we see as the summer goes on, because as you're talking about, we're seeing a lot of demand by people to get out. They've been locked up for 2 years. But does that continue into the fall when gasoline prices start to fall? Or do people say, okay, we did our traveling and we pulled back? And one of the key things to watch is how much are people going to be spending this fall? Because right now, retailers have to start thinking about what they're going to order for the holiday season. So we'll be talking about this question come October, November, and whether they have enough inventory and whether they have the right things and whether they can get that inventory from China. This is a problem that's not going to go away.
Hey, guys, thanks a lot. Really fun roundtable. Really appreciate your time. Bloomberg's Michael McKee and Poonam Goyal of Bloomberg Intelligence. Thank you both very much. All right, well, coming up, our next guest says that in a few months, we're going to get to a place where bad news is good news. Signs of a slowdown will ease the Fed to ease off those brakes. We're going to talk to the CIO of Kestrel Holdings CIO, Kara Murphy. This is Bloomberg.
I think what we have here is a pretty powerful tension between drags that are not going away and a very resilient private sector, with the health of both households and corporates being quite remarkable right now. I think what we're going to see is growth continue to be on the softer side, but growth continue to show resilience. We don't see a near-term recession. We see a global economy which actually does okay in the second half of the year, with the U.S. slowing and the rest of the world doing somewhat better.
That was Bruce Kasman, J.P. Morgan chief economist, saying he doesn't see a near-term recession coming. So let's get back to our question of the day. Does a margin meltdown mean a crash landing for stocks? Well, Kara Murphy, Kestrel Holdings CIO, joins us now. Kara, the question for you, and this is obviously based on what we're seeing with Target. What do you think?
So I'm going to take the other side of some of the comments that your earlier guest had, and where I think the kind of issues that Target is dealing with today are signs of a broader macro issue. So we are seeing supply chains ease, and those goods are starting to come through that supply chain and land on retailer shelves, just at a time when consumer demand is actually coming down. So that's led to this, start of an inventory glut, and it's high level of difficulty for various retailers to try and deal with this fast changing environment. But we're seeing on a macro level, supplier delivery times are declining, inventories are rising. All of this is happening really across the economy, and some retailers are better able to deal with it than others.
What's the signal then for the broader economy? Is the consumer struggling? Is this the early innings of the consumer struggling? What is the kind of, just go into a little bit more detail on the macro signals here.
So, we've talked earlier about the very strong savings on the part of consumer, very, very strong labor market. Those savings rates are starting to be worked down. People are shifting their buying habits from goods to services. So all of that is sort of like the natural part of the cycle. But I think the key here, what's going to really change consumer buying habits, is weakness in the labor market, which, by the way, we are starting to see. It's very early days, but more signs that we have that the labor market is starting to ease, that will really change consumer behavior and have them start to retrench a little bit in terms of spending.
So, Kara, if you were to put the odds of a Fed engineering a soft landing, what would the odds be? Because that kind of trickles down then into what kind of hard or soft landing we may see, say, in the equity market.
For sure. Now, high level of difficulty, right?
Yeah.
But we still think it's better than even that the Fed engineers a soft landing. And all of the traditional indicators that we look at to tell us that a recession is coming are not yet sending a red flag. And so we do still think that this moderation in demand is going to be the theme for the second half of the year. It's been the theme for the first half as well. And we think that there's a lot of room, you're talking about corporate recession, there's a lot of room in company balance sheets and income statements to have softening, but still be able to continue providing growth.
So, Kara, where does the stress come in terms of the profit and loss account? Presumably what you're signaling there is a top-line slowdown as well as a margin squeeze. That is terrible for profitability. What is that going to mean in terms of earnings?
Yeah, so right now, we're still looking at about a 9% expected corporate earnings growth for 2022. I think those expectations do indeed come down. But I think the most important impact on a market level that we see are a continuing preference for companies with stronger balance sheets, more reliable cash flows. We've started to see the market, sell out of names that aren't making money, but we'll continue to have this rotation into the types of business models that can better withstand this type of volatility.
Yeah, but what's interesting is that I would think that something like Union Pacific would fit that bill. They're also typically really good at being able to manage these kind of issues, and even they are having operational problems and inefficiencies.
Well, for sure, this is a very high level of difficulty. We've talked about this whole cycle starting with March of 2020 as being a cycle on steroids. Everything has been on fast forward. So even your really well-run companies that have been through tough cycles before are really struggling. But the question is this going to be a one-time, and is it going to be a persistent issue? And I think the better companies are going to be able to regroup and understand that we're in a new market environment and be able to react appropriately.
That new market environment, let's just talk about it. How do you see inflation evolving in the kind of scenario that you've painted?
So we think over the second half of the year, we'll continue to see moderation in inflation. On the good side, it's much easier to track that, right? So we can see goods coming through that supply chain pipeline, and they're starting to fill up, and that will bring down goods prices over time in the second half of the year. Services inflation is a lot harder, right? But that tends to be much more tightly linked to the labor market. So that's why we're following those indicators very closely. We're starting to see quit rates increase. Again, just a little bit. It's early days, but they're starting to increase. We have labor force participation rates back to pre-COVID levels. Small businesses are saying they're not going to raise earnings anymore. So I think the more that we see those types of indicators, it bodes well for moderating services inflation in the second half of the year.
Okay, so Kara, based on that, if you are looking at companies that have good quality balance sheets that can make profits, et cetera, where is that right now?
So on a broad level, we're looking at a rotation into value. So more value-oriented names, they have a little bit more cushion because they have lower valuations, expectations are a little bit lower, and you tend to have companies that have, more sort of defensible business models in rough economic environments.
In this kind of environment, how long does the US 10-year stay above 3%?
So we need to be, if we're right and inflation starts to moderate, growth starts to moderate, I don't know that 3-year bogey really stays for very long. If past experience holds, then that moderating inflation, moderating growth outlook should start to drop those long-term rates over time.
So does that mean that the Fed can't go as far as we think then? Or are we just going to be in a higher yet subdued new range for the 10-year?
I think the Fed, we're in this moderating environment because the market has already anticipated these rate increases by the Fed. So the Fed has to really continue to press on the brakes. And we think by the latter part of this, and by the fourth quarter of this year, as inflation and growth starts to moderate, that's when the Fed can kind of reevaluate. But they have to be aggressive until they get that. They have to earn their, the market's respect back, that they can actually bring inflation under control.
It's going to be a bumpy and interesting second half of the year. Kara, thank you very much indeed for joining us. Kara Murphy, Kestra Holdings. Great stuff. Thank you. Okay, the U.S. Treasury Secretary Janet Yellen is currently testifying. She's doing so before the Senate Finance Committee. She's doing so on President Biden's 2023 budget. We will continue to monitor what is happening on Capitol Hill. We'll bring you the headlines. This is Bloomberg.
Access to clean drinking water.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Shares at Target are falling. The discount retailer cut its profit outlook for the second time in 3 weeks. Target's trying to ease a surge in inventory by marking down more merchandise and canceling orders. Operating profit will fall to about 2% of sales in the current quarter. That is well below the 5.3% target estimated 3 weeks ago. And Kohl's is in exclusive talks with Franchise Group for a deal that would value the retail chain at about $8 billion. Franchise Group's offer is for $60 a share. That has Kohl's shares surging. In February, Kohl's said it had rejected takeover offers because they undervalued the company. And Citigroup will hire about 3,000 employees for its institutional business in Asia. The new staff will work in areas including investment, corporate and commercial banking. The bulk of them will work in Hong Kong and Singapore. There will also be new jobs in India, South Korea, China and Australia. And that is your latest business flash, Alex.
All right, thanks so much, Ritika. Treasury Secretary Janet Yellen speaking before the Senate Finance Committee. You're currently looking in there at Senator Wyden was starting the question. Janet Yellen just finished reading her prepared statement. A couple things we're going to be paying attention to. Yes, it's about the budget, but this comes on the heels of Janet Yellen's mea culpa on inflation that came out last week, plus confusion over what she actually said about President Biden's fiscal package, that pandemic relief package. There was a book that is coming out on empathy economics, and there's questions as to what she actually said in that book about her support for that aid.
Yeah, she's in a real difficult spot, isn't she? She's got a lot of history in terms of monetary policy. She's obviously got the fiscal policy mandate right now. I think there is a growing consensus that the economy didn't need all the stimulus. How that is going to be couched, how the mea culpas are going to develop, how the history books are going to tell the story, I think is going to be really interesting. At the time, a lot of people were very financially stressed. The US went down the model of not supporting jobs, but supporting people. It was helicopter money.
Yeah.
It was really difficult at one point to justify not providing people with that money. But it was as the story progressed and the exit became clear post the Pfizer news on the vaccine that I think the monetary policy and the fiscal policy, probably with hindsight, should have started to alter its trajectory.
Well, you have to wonder, too, though, in part, the high inflation and the Fed tightening now, the consumer is able to manage it in part because of those pandemic checks that they just started cutting. The savings rates come down to 4.4%, but they had the cushion, and that's now helping them manage all of this. I don't know if that's good or bad. Like, do you want to destroy demand faster, or is the fact that the consumer is actually going to wind up being okay actually better? So I'm very interested to hear, Guy, as we go forward, sort of the questions that she's going to get out of the Senate.
Yeah, but that's kind of chicken and egg argument, isn't it? Would we have had the high inflation that the checks would have been needed for if we wouldn't have had the checks in the first place? That's the bit that I can't figure out. Anyway, we'll get back. We'll talk more about Target next. Stocks under pressure. This is Bloomberg.
We're an hour into the U.S. trading session. You may not have expected what has unfolded when we got that Target news a few hours ago. We're now almost flat on the S&P. Bloomberg's Abigail Doolittle is tracking some of those moves. Abigail?
Yeah, Alex, it's almost a turnaround Tuesday, not in the traditional sense, but from that ugly open down more than 1%. The S&P 500, to Alex's point, basically flat at this point, down just fractionally after yesterday's gain. Let's see whether or not it can turn around. And of course, one help for stocks today, and especially the NASDAQ 100, those tech-heavy stocks, yields are in after backing up about 30 basis points over about 5 or 6 days or so, 6 sessions. You now have that 10-year yield back below 3%, makes valuation look a little bit more attractive. The VIX, though, this is so interesting. There continues to be a little bit of a disconnect between stocks and the VIX. Let's see if the VIX can go below 25. As for the future look at the S&P 500, everybody wondering whether it's a bear market rally or the start of something new. This is interesting. This is the breadth, or one way of looking at the breadth on the S&P 500 and the number of S&P 500 members above the 50-day moving average. So that's near-term momentum. Now, you can see over the last year or so, it is certainly declining. But after touching the bottom of this range, it appears as though we could actually see it go back higher. So currently, about 41% of members are above their 50-day moving average. This chart suggests that in the relatively near term, it could go closer to 60 or more. So that might make the case that the bounce that we've had over the last week or two, a bumpy bounce, but it could continue. As for Target, I'm so curious to take a look at this chart, because earlier today I was having a conversation wondering whether or not we could actually see Target go green on the day. Now, this is a 2-day chart. This is the 1-day price change. Earlier in the pre-market, Target on that bearish pre-announcement, the second one in 3 weeks, now down just 2%. 10%. Earlier, it had been down 9% here, but investors taking a cooler look at this. But of course, valuation, because as this company slashes numbers, they could attract people in. The first thought that I had when I heard about this second pre-announcement slashing of the operating margins to 2%, big discounts, was go to Target. What could be on sale there? And they are, in fact, holding the year numbers for a 6% margin later in the year, and they're holding revenue. Let's see what happens here. This story continues to evolve. One thing that's clear, though, on this year in 2022, consumer staples, think Kraft Heinz and other real staple type companies, down 5.5%. Some real outperformance there relative to consumer discretionary, down 26%. Very interesting, though. Walmart had an interesting or a similar story relative to Target. That's in the staples. Target's in the discretionary, and then there's the S&P 500. But that defensive staple sector certainly providing the defense so far this year, Guy.
Abigail, I don't think you're alone in that thought. I'm pretty certain that Alix Steele probably had that thought as well. A person who doesn't like to buy full price.
Never, ever, ever buy full price.
Yeah, exactly. So I think there's some opportunities coming up. Where do consumers stand in all of this? Well, let's figure out exactly where we're going to go, both with the consumer and with Target and the whole sector. Dreyfus and Mellon chief economist Vince Reinhart talking about the story surrounding the consumer and the risk of a recession on Bloomberg TV earlier today.
The key metric right now that tells you households aren't really that worried about recession, saving rate is low. If people were worried about their income prospects, they wouldn't be spending so much out of their income.
Joe Feldman, Telsey Advisors Group senior retail analyst, joining us now. He has an outperform rating on Target. He's cut his price target on the stock, 305 down to 200. Let's talk a little bit about what the signal is here. Is there a macro signal in what Target has announced today, or is this a Target-specific issue?
I think there is some level of macro signal here related to the discretionary side of the business. The consumer has slowed down sales on discretionary, particularly home-related goods and other outdoor-related categories that they were spending a lot on the past couple of years during the pandemic. And there's an excess inventory that needs to be cleared out. However, the sales, the top line for the company is actually quite strong, and they're seeing footfall increasing at their stores. People are actually visiting more frequently. So they are buying things. They're buying consumables, essentials, and other products. They're just not buying as much discretionary goods. So I think that's probably the biggest macro signal there, that there's just been a little bit of a shift in what consumers are spending on right now.
Hey, Joe, I feel like this was the conversation when they came out with earnings 3 weeks ago. And I'm just wondering kind of what changed, what kind of clarity they got, or what did they get over the last 3 weeks that made them have this kind of pre-announcement?
Yeah, we were thinking the same thing because they just told us that exactly what they're doing is what they're doing now. It does seem that the level of markdowns that they're doing and clearance to remove the inventory that's excess at the moment is higher and more aggressive than what they had initially thought. And I think that they're seeing more pressure there. And so as a result, they basically had to slash their profit numbers by a fair amount for this second quarter. It does feel like it's going to be more isolated to the second quarter. I'm sure some will drift into the third quarter in terms of some clearance, but they are working aggressively to get into a clean inventory position for the second half of the year. And this is something we've heard from other retailers as well. If you go back to a couple of weeks when Walmart reported earnings, they basically said the same thing, and a lot of other retailers are doing the same, where they are trying to, working through some of the inventory levels to get in a better shape for the second half.
Joe, is the consumer more difficult to predict in terms of what he or she is going to be spending money on than normal?
Yeah, I think it's been a little more challenging lately because you're seeing a bifurcation in the consumer, where that lower to middle income consumer is under a lot of pressure. And we're seeing that real focus on saving money and trading down, more private label purchases for that consumer, and really a focus on essential goods, food and basic household daily needs. At the other end of it, you're still seeing that middle to upper income consumer spending at a relatively normal rate as to what they have been. Now, they have been shifting away from discretionary a little bit, but the more affluent consumer is still planning to take a lot of trips. They're shifting towards going out clothes and more party-oriented things and trying to re-engage. So you're still seeing some level of spend on discretionary at the upper end. It's just at the middle to lower where it's really been a lot of pressure.
All right, so the stock's trading right now 157. When do we know is the right time to buy Target stock, knowing that they're not going to go out of business or anything anytime soon, and they're still going to be a good staple for consumers?
Yeah, I mean, it feels like a pretty decent value today, actually. And as you guys are mentioning earlier in the previous segment, that the stock's actually bounced back quite a bit from its initial low. And I do think that investors were expecting things to get a little bit worse before they get better. We certainly were. And if anything, this may not be the end of it. There could be more revisions as the year goes on, just given the volatility with the consumer and all the macro pressures that we're dealing with. But at the same time, the stock, even at a new lower earnings per share, $8, $9 a share this year, maybe it's 13, 12, 13 next year, it still looks like you can get to, kind of 175, 180, somewhere in that range from where we are today.
Joe, a lot of what was planned this summer by a lot of people, and I'm talking about probably the second group that you were referencing there, was probably predetermined. They made a lot of the decisions on weddings, on vacations, etc., probably 3, 4, 5 months ago. What happens later on this year? The cost of living squeeze is coming. Stock prices are down. It is getting tougher out there. How easy is it to predict, for instance, the holiday season right now?
I think it's very challenging to predict the holiday season right now. I think, look, holiday always comes. Everybody wants to celebrate and spend some money, but it's really difficult. As you guys have been talking all morning and recently, gas prices are killer right now for the consumer. I mean, when you go fill up your car and you see the ticket and the sticker shock on that gas fuel, it's really difficult, and it causes the consumer to really rethink what they're spending on. And I think you're right. A lot of, the summer travel and some of the weddings, things were kind of baked in 4 or 5 months ago, and it makes it for a very difficult second half. We're hopeful that inflationary pressures will ease a little bit as the year goes on. And if that is the case, that might help a little bit. Maybe oil prices, gas prices can come down a bit. Yeah. That would certainly help. But it's really going to be challenging. I think it's going to be a tough holiday right now as we sit here today.
Okay, here's what I'm doing. I'm going to buy the stuff that's going to be on sale now as they clear their inventory to then give it for Christmas gifts. I'm just saying that's the way forward. Hey, Joe, before we let you go, what other stores, if we look at what Target said today, what other companies are going to have to re-rate their profit margins to the downside, and is that fully priced yet?
Well, I think there are some, where there's more discretionary leanings. We've already heard some, like the big lots. Five Below is going to report tomorrow night. Some of the more discretionary-oriented companies that we cover, I think, are going to be challenging. I think some of the department stores I worry about. But at the same time, you have some of the core discount, the dollar stores, the Walmarts of the world. Even Tractor Supply had a positive pre-announcement last night, where they're still seeing good outdoor sales for lawn and garden and things. And that bodes well for Home Depot and Lowe's. So there are pockets of the economy, or the retail sector, I should say, that are hanging in okay.
All right, hey, Joe, really appreciate it. A great perspective today. We appreciate you breaking down the numbers for us. Joe Feldman of Telsey Advisory Group. Coming up, consumer spending habits are definitely changing because people are actually traveling again. Those sky-high airfares are the latest headache for those globe-trotters. We're going to speak to Alaska Air's CEO coming up next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Coming up, Binky Chadha, Deutsche Bank Securities Chief Global Strategist, joining Bloomberg Television, 3:30 p.m. New York time. This is Bloomberg. Keeping you up to date with news from around the world. Here's the first word. I'm Ritika Gupta. Boris Johnson is trying to draw a line under the controversy that's been threatening his leadership, but the scale of a mutiny against the British Prime Minister suggests his days may be numbered. Johnson survived a confidence vote by members of his own Conservative Party. Still, more than 40% of Tory MPs voted against him. Johnson now says it's time to get back to helping people with the cost of living. Russia has come out with its own sanctions. It has indefinitely banned 61 U.S. officials and executives from entering the country. Amongst them, Treasury Secretary Janet Yellen and BlackRock CEO Larry Fink. Moscow says it's retaliating for what it calls constantly expanding sanctions against its citizens. And Hong Kong won't tighten coronavirus restrictions before the city's July the 1st handover anniversary. That is according to Chief Executive Carrie Lam. There's been speculation that China's President Xi Jinping might attend the celebrations. Hong Kong's COVID cases have been rising since the city began rolling back social distancing curbs. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg Guy.
Ritika, thank you very much indeed. Alaska Airlines is on a new journey, a 5-part path to net zero carbon emissions by 2040. Joining us now from the Up Summit is Bloomberg's Ed Ludlow, who is there today with the CEO of Alaska Air. Ed, over to you.
Yeah, good morning. We're in Crystal Bridges Museum, downtown Bentonville, Arkansas. We're surrounded by flying things. These are battery electric, future flying, autonomous ride-hailing technologies. You're laughing at me, but your goals are a little bit more near-term when we talk about investing in technology. You're super focused on efficiency, and last night you did this flyby. Tell me about the flyby. What was that about?
You know, it was our 737 MAX. It's our sustainability livery. It's got a beautiful orca on it, but it's our most modern airplane in our fleet. It's 25% more efficient than the A320s it's replacing. And we've got, I mean, the way I think about it, Ed, is, we've got existing infrastructure with our existing airplanes. So we're making operational efficiencies. Sustainable aviation fuels is a big enabler for us to get to our aggressive goal of 2040 to be net zero. And, being here at this conference, watching all this amazing technology, it's mind-blowing. I've been in the industry over 30 years, and watching this industry transform before my eyes, knowing that there's an airplane that flew from Vermont to Bentonville, battery-powered electric airplane.
1,400 miles.
1,400. It's
well, you're also an engineer by training.
Yeah, so I love this stuff.
And I should clarify, this was a low-altitude flyby. It literally went over my head. I wasn't expecting it, which is why you're laughing at me. But ultimately, this is about the bottom line, right? You revised guidance recently for the current second quarter. Fuel was a big part of it. Explain that, connect your revision to guidance for the need to look into more efficient fuels, invest in technology.
Well, just to give you a sense, an airline has a cost structure that about 60% of it is just labor and fuel. And so as we look to the future, we're using hedging strategies, so about half our fuel is hedged for this year. So, I mean, we'll save $200 million with our hedge strategy. But as we look forward to the future, we need an alternative source, and I think sustainable aviation fuels can be produced. Right now, it's not affordable. I mean, that's the issue with sustainable aviation fuels. Even if it was $1 more per gallon than traditional jet fuel, and we burn $1 billion. We burn 1 billion gallons of fuel a year. That would be $1 billion. It would wipe out our entire profits. I mean, so that's the question: is how do you produce enough volume of sustainable aviation fuels and do it affordably?
Guy and Alix are chomping at the bit, but I'm sticking with tech. Okay. Artificial intelligence.
Yes.
You talk a lot about artificial intelligence. Why? How does that help you?
We took a bet in 2018 on 3 entrepreneurs who came in and they were doing AI and ML for self-driving vehicles, autonomous vehicles, and they thought that their software was applicable to commercial aviation. So they came to us and said, "Hey, you're an airline that likes innovation, and can we get exposed to what you do up in the sky?" And we worked with them for 2 years, and we developed new flight plans, working with our dispatchers to fly airplanes from point A to point B using artificial intelligence and machine learning that saved us about 3 minutes of flight. In 2016 alone, on 20,000 flights, we saved 11 million gallons of fuel using AI and ML. And we just bet on 3 young guys in their 20s, and today it's a 65-person company. They're in 3 countries, and airlines are lined up ready to sign with these guys. It's just a great example of industry coming together with entrepreneurship.
Ben, it's Guy. Can I jump in and ask some questions? Because I'm fascinated what you said just a moment about SAF and the scalability of the problem. But what I really want to know is what comes after SAF. So you're swapping the 320s for 37s. The 37 is a more efficient aircraft than the 320s it's replacing. But what comes after SAF? Because at the moment, Airbus is investing heavily in hydrogen. Do you think that's the right call? Boeing, less convinced at this point. Do you think that's the right call? What does a post-SAF world look like for the aviation industry?
No, Guy, it's a great question. And again, I think I look at it in two steps. One, sustainable aviation fuels is the first step to bridge existing infrastructure. The second step is what's the next generation airplane going to be? And we know it's going to be electric. The question is, what is it going to be powered by? Is it hydrogen? Is it battery? And I think what's fun about being at the Up Summit is you're seeing this amazing technology come in. Again, I'm an engineer, so I love seeing all this technology. And I'm just not sure myself whether it's going to be hydrogen powered. Can you make batteries light enough that they can actually power large aircraft like a 737 type of airplane, an Airbus type of airplane? I know it will work with smaller airplanes, battery powered. But I think for the big airplanes, has to be a technological leap. And I'm not really sure what that next generation airplane is, but I do know it has to be different because as an industry, we need to make that leap. And I'm excited. Guy, I'm watching all this amazing technology. And again, it's just transforming the industry before my eyes.
But do you think ultimately that the power plant, so it's interesting, do you think the ultimate power plant is electric and the hydrogen will effectively feed that electric motor? Or do you think actually the power plant will be hydrogen powered? A lot of people are trying to figure this out at the moment. You're an engineer. What is your best guess on that?
Yeah. My sense is I think it'll be electrically driven. Now, what the power source is going to be, it could be battery powered, it could be hydrogen powered. So I do think it'll be electrically driven. Now, what the power source is going to be, I think, is to be told.
Ben, you, through your venture arm, are one of the LPs in Up Partners Fund, right? You know Cyrus Sagari very well. That's why you're here. You know people in the room.
Right.
And the conversations I've had, the world is changing. It's different, even still from 2018. For you, it's issues of inflation, labor, but also demand, pent-up demand. How do you see the world right now from that perspective?
Ed, it's a great question. If you would have asked me a few months ago in the depths of Omicron, I would have been worried that fuel was going, oil is going to be over $100 a barrel. There's inflation that's high. There's a risk of a recession. But demand is amazingly strong. We're seeing demand at levels I've never seen in my entire career. So as an industry, as airlines, as Alaska, we're actually going to be profitable this year, believe it or not, with fuel so high. So but we've got, we're watching every day if this thing is going to turn. But so far, there's been no abatement in demand.
You and I are West Coast guys. We talked about the options that are out there. Business travel, how is that looking?
It's coming right back. Yeah, business travel for us is back to almost 80% levels from 2019. So business is coming back as people are coming back to the office.
All right, Ben, I wish we had more time.
Yeah.
It's always great to catch up. Guy, I knew this would be right up your alley. What a fascinating conversation here from the Up Summit in Arkansas.
Yeah, we didn't even get to talk about JetBlue Consolidation, what's happening there. This is a conversation that we could do a lot on. I'm going to IATA soon. I will be having a lot of these kind of conversations with airline CEOs, the long-haul versions of the industry. Ben, great stuff. Thank you for joining us. We really appreciate it. Ben Bittacucci, the Alaska Air CEO. Great stuff, Ed. Thank you very much indeed. Ed, Ludlow, having fun, I think, at the moment. Alix.
Yeah, we're taking a look at Janet Yellen. She is still testifying at the Senate Finance Committee. She's answering some questions. Just a few things about inflation. She says a third of inflation is new and used cars that are affected by chips. She also talks about the chip shortage and said and highlighting the Fed's important role in fighting inflation. So continuing to pass that buck over to the Fed. We'll continue to update those headlines as they cross. This is Bloomberg.
Right, so let's talk about where we are with European markets. We are heading towards the end of the day this Tuesday. Stocks are on offer. We're down by around 0.2%. So at a headline level, not really a significant move. Where we are seeing a significant move is actually in reaction to what we got from Target today. So retail is the worst performing sector here in Europe. The pound, I'm not sure the pound's really trading on Boris Johnson and his problems right now. But nevertheless, we are seeing a little bit of traction today. 125.80 is roughly where we're trading on the cable rate. Brent crude is up by around 0.9%. But Boris Johnson is certainly having a few issues right now. He had a cabinet meeting a little bit earlier on today. He basically sent the message out that we're going to draw a line under Partygate. Most people don't believe that that is going to be the case. Most people believe that that is ultimately wishful thinking. Ultimately, we are going to see potentially a change in Premier here in the UK. What are the implications of that? And what happens in between now and then in terms of the policy story going forward? Lila Housen-Smith, Global Counsel Associate, is joining us next. She's got a huge history in government. She knows a lot about what is happening at 10 Downing Street and at Westminster. We'll get her take on what is happening here. That conversation next. This is Bloomberg.